And if you misunderstand risk, it's literally impossible to devise an investment program to maximize return.
These questionnaires tend to encourage us to make long-term decisions based off of short-term feelings.
What level of loss are you emotionally comfortable with?
I heard I should invest. What I actually invest in, I'm just gonna kind of like pick whatever they tell me to.
I'll say it like this. I don't own bonds in any part of my individual portfolios. If you start with $1 million, 30 years from now, you still have $1 million on paper. You can only buy 40% of the things that you could have bought 30 years ago. There's two reasons why these questionnaires are wrong. Welcome to Beyond the First Million. I'm your host, Gideon Drucker. The taller gentleman to my left is Jordan Haines. I hope he is to my left. Yes, we're right. How you doing today?
Good. I don't know how it works with cameras. Are we like backwards?
It's our left, it's their right. Yeah. We're good. This is the podcast about how the Knicks just won the NBA championship for the first time in 53 years. No, that is not what this podcast is about, but I had to mention it. I actually don't know when this is going to be airing. The Knicks are NBA championships for at least another 12 months. We didn't actually talk about this. I know you're a Utah Jazz fan.
Yeah.
You were rooting for the Knicks.
Yeah, I was rooting for the Knicks. Yeah. I didn't really have like a horse in the race. I just enjoyed.
Other than that, Wemby just seems pretty lame.
Yeah. Yeah, he's great.
Yeah, this podcast is a pro-Knicks, anti-Wemby podcast, and we'll leave it at that.
How many hours of Knicks content have you listened to? You told me this before.
A dangerous amount. When your team wins, and again, I am a Knicks fan. I won't say I'm like the most diehard, but my family has always been a Knicks fan. So yeah, it's been a fun few days. See, this was maybe not the best strategy because everybody that's not from New York has already turned off the podcast. So we're going to bring us back to what we actually want to talk about today. It's one of the most common things that you and I both experience when we're meeting a prospective clients, that most of them are in their late 30s, 40s, maybe early 50s. They're making good money, they're saving aggressively, they're organized, they know kind of the direction they want to be going. And then when we look under the hood of their investment accounts, a lot of times they're 20, 25 years away from retirement, but they're invested like they're 5 years away, right? Like their actual investment plan really doesn't match their time horizon where they're going. And by that, we mean they have a relatively high amount in cash and stable income funds and fixed income or bonds. And most of them really don't have any idea of how they got there. It wasn't a planned strategy. Nobody ever sat them down and said, hey, you're 40, but let's invest like you're 60, 65 years old, right? It just kind of happened. What's the number one reason you think for a lot of people, just knowing how people tend to invest, how they got there?
I think there's two. And we've talked about this, and I'm always the guy who's coming back to this, but I just don't think a lot of people know what they're investing for in order to decide how they're going to invest. Right? It's almost just like, I heard I should invest. So I'm going to open an account and I'm going to put money in it and I'm going to invest. And what I actually invest in, I'm just going to kind of like pick whatever they tell me to.
Right. And so let's talk about the they. This is not about advisors, but it's risk questionnaires.
Yeah.
Most people, if you've invested your 401k, you have an advisor, or even just you're on a brokerage platform, right? It doesn't even have to be a one-on-one person. You've done one of these risk questionnaires where basically it's software, it's an algorithm where you start answering questions. Hey, if there was a 50% chance that you could go up 20% or a 50% chance that you lose 50%, would you do that? And it just continues to ask questions. Hey, if there's a chance you can go up this much, and it changes the numbers, but to arrive at how you feel, your emotional makeup when investing, right? What level of loss are you emotionally comfortable with? And then you answer a bunch of these questions. Every platform I've ever seen has this kind of risk questionnaire makeup. And then it spits out, are you aggressive? Are you conservative? Are you moderate? Sometimes it actually assigns you a risk number, 1 to 100. And then from that point forward, your investment strategy is largely determined. Oh, Jordan, you're a 65, that's moderate. You're going to have a 70-30 portfolio. Gideon, you're aggressive, a 94, and these numbers are meaningless. I'm just throwing them out there. You should be in a 90-10 portfolio. I think most of that, and try to stay away from absolutes, but I think most of risk questionnaires are nonsense. I think they actually, not intentionally, and we'll talk about what their purpose is, but mislead investors into underperforming how they need to be set up for the long term. And it's not because they're evil. Maybe we should just get this out of the way.
They're not bad.
Yeah, they're not evil. They're not trying to do anything wrong, but they misunderstand what risk is when investing. And if you misunderstand risk, it's literally impossible to devise an investment program to maximize return. We'll start by being fair that these risk questionnaires weren't invented by idiots.
No.
There's a purpose to them. We don't really use them. We can maybe come back to how we think about them, but if they start a conversation about how you think about investing, about how you think about money and risk, great. But that's not often what happens. What usually happens is you answer the questions, you're assigned a number, you're set up in an allocation, and you never think about it again.
Yeah. A couple thoughts I have on this. I think as a financial advisor who works with people and helps them invest their money, it is actually useful context for me to understand, like, how do you actually feel about risk, and when are you going to be concerned, when do we need to have these conversations? That is helpful.
It starts conversations that might be otherwise difficult to have.
Yeah, but it would be like if I were to go to a personal trainer and be like, hey, help me be healthy. And they're like, what makes you feel happy when you eat? And I'm like, I eat Whoppers because they're good. And I like me some Chick-fil-A because it's good. So that's what I'm going to have for my meals. No personal trainer is going to be like, yeah, that's what you should just do. Like, I'm just going to say, we're going to do what feels good to you right now. Right. And that's kind of what the risk questionnaire does for a lot of people.
Right. From the advisor perspective, or just the platform's part of it, there's a CYA. There's a cover your ass in there of, hey, if we have these people answer these questions and it spits out their investment, so we're just doing what they answered, right? Well, no, how about we educate, we talk about how that all comes together. Let's actually talk about what risk questionnaires actually do, like what they are telling you, and then we'll talk about why, to your point, feeling good or how you feel in the moment isn't really accurate. So at the simplest level, you answer a risk questionnaire, and if it says you're more aggressive, you're going to invest more in stocks. And if you're more conservative, it'll say you should own more bonds. It's that binary in terms of how these questionnaires are focused. There's two reasons why these questionnaires are wrong. First one is kind of what you were alluding to. It's alluding to how you should be invested for 30 years based on how you feel emotionally in the moment, right? Literally, there's studies on if you take a questionnaire and you just got a big bonus, you just got a big promotion, you're in a good mood, you're feeling confident, you are going to think you can take on more risk at that moment because you are more confident in your life. And by the way, it doesn't even have to be about finances. You had a really good date. Your kid scored the winning goal at a soccer game. Like, you're going to be a little bit more just like balls of your feet optimistic, and how you answer a risk questionnaire of how much risk you're comfortable taking on is going to be higher. But it's human nature. We answer questions about long-term risk based on how we're feeling in the moment.
The general principle I'm hearing from you is these questionnaires tend to encourage us to make long-term decisions based off of short-term feelings. And I think that, to me, goes back to, well, you need to know what you're investing for. And the vast majority of people, especially people that we work with, are investing for the long term.
10,
They're
20,
investing
30
for
years.
something very far in the future. And so knowing that, why would we now make a long-term decision based off of how we feel right now?
Something that can literally change by next Tuesday.
Yeah.
And for our role as advisors, and the personal trainer analogy is spot on here, you hire a financial planner to educate, to help you understand what you're invested in, how the plan comes together, and to get you out of your own way. If our job is just to, all right, you filled out a questionnaire and now let's go put you in the model that matches, literally, what are you paying us for? Why are we here? How you think emotionally about money and about investing matters. We're not trying to say you should totally ignore if you think you're a conservative person or you're aggressive, but I've absolutely had people on our initial Right Fit call, they'll say, hey, I want you to know, like, conservative when it comes to investing. I don't like a lot of risk. And then we have 5, 6 meetings, right? We build out their financial plan. And by the time we get to the investing and we lay out, hey, here's how we think about short-term money. We want your short-term money to be in cash because you might need that in the next 1 to 3 years. And we do not want money that you might need to be invested in something that can fluctuate. So we want that money sitting aside. And then when they say that, they're like, oh, yeah, that's what I meant by being conservative. With my bank account, like, I like having a lot in the bank because I'm planning for putting in a pool. We'll say, well, yes, of course. But that doesn't make you conservative. That means you have a financial plan that's matched to when you need to spend your money. And if somebody had just taken that comment at face value, hey, this person's conservative, let's invest like she's conservative, it would have totally, thrown off the returns she would earn long-term, but it's not diving deep enough, right? Our job is to ask questions of, hey, why do you think you're conservative? What leads you to that? Are you conservative with all of your money or with this part? And then educate, and this is what we'll get to. The second reason that questionnaires are not helpful is that it misunderstands risk and volatility. And a lot of people, when they say, hey, I'm conservative, that's what they're doing. But sometimes when somebody says, I don't want to be aggressive, in their mind, they think aggressive means day trading, owning 7 individual tech stocks. These words have different meanings to different people. And if you're not educating and unpacking, we could be driving in totally different directions here.
Yeah. What I'm hearing from you and through all this is, I think it helps to have someone to talk to about this. I think in our relationship with our clients, it is nice to be able to challenge their notions a little
their
bit,
assumptions,
to educate, right? Like, we can take what they're feeling And then we can challenge them a little bit and we can educate them. And questionnaire in and of itself, if we were just take that at face value, it wouldn't do that. And so having your advisor or someone that you trust listen and have them challenge your opinions, I think is really helpful.
We're saying that the real issue is, hey, making long-term decisions based on emotion is the main problem. How should we be measuring how we invest, right? Like, what are the right ways of thinking about it? Yeah. And this is where we like talking about what we call, like I invented it, risk capacity, right? As opposed to risk tolerance, right? Risk tolerance, we're describing, it's an emotional reaction. Risk capacity measures, for lack of a better word, data. It looks at how much market decline, which is really what we're talking about, right? When you invest, how much can you afford to lose in your actual financial plan? Not how do you feel about it, how will you emotionally react, but based on your living expenses, your cash flow, your other investments, your cash needs that you need in the next 3 years, how much could the market lose that would affect you or not affect you based on your actual financial situation? So let's set the stage. Let's use an example. Imagine you're 40 years old, you just received a large bonus, something that isn't every month. And so there might be periods where your bank account is smaller, and then there are parts of, oh my God, I have 500,000 sitting in my bank account right now. Yeah. Right? So let's say you're at that point, you have 500,000 sitting in cash, and let's say 6 months of living expenses for you is 100,000. That's how much you just wake up in the morning, it costs you 8 to 10,000 a month to live. And let's say you're planning to put in a pool for 125,000 next year, and you're saving 10,000 a month just in cash flow, in 401k, savings, investments. That person, they might say, oh, I'm pretty conservative, like, markets freak me out. But their risk capacity, right? If we actually measure what can they afford to lose in the short term, how would that impact them? Because 500,000 in the bank, they need 100,000 for their living expenses, 6 months. Let's just say that's what we're working with. We need to set aside another 125,000 for the pool, because any money that you might need in the short term, we do not want invested, right? Because I keep saying short term, it's no longer short term if in a year from now, the market's down 20% and your 125 is less than 100 and you need that full amount to put in a pool. No longer short term, it's actually in the moment, right? So that money's set aside. You're saving and investing 10,000 every month. Your risk capacity is pretty darn high, right? You have 200,000 to 300,000 and most of that 10,000 a month that you can invest. And if the market went down 20% next month, 40% a year from now, it would have absolutely no impact to your financial plan, your investment needs, or your family lifestyle, right? There would be nothing changing in your family financial circumstances because the market went down. That's what we mean by risk capacity.
Yeah, I think one is very subjective, right? Your tolerance, how you feel about things. The other one is very objective, what's actually happening in your life. Something that stood out to me as you were talking is you relate capacity a lot to time. To my point earlier that we need to know what we're investing for. A lot of times we need to know when we're investing for.
Yeah.
Right. And so like,
Absolutely.
Is it something in the next 2 years? Right? Yes, we need to have that. Like I have a young family, we're growing, and there's always random things that are happening. And so normally I might be comfortable with 3 months in the bank. Right now I really want 6, like I need that. And sometimes I'll have a client that's like, I need a full year.
Yeah,
like
absolutely.
I had a client, they were unemployed for 6 months last year and they're doing fine, right? Like all things considered, objectively, they look at things, but they're feeling uncomfortable about. So we said, hey, let's have about 9 months of living just in cash. And that makes them comfortable to say, okay, I'm okay to invest the rest of this for the long term, right?
100%.
Capacity.
Yeah, perfect is the enemy of good. And I'm glad you flagged that, because when I said 6 months, it was an example, yes, 3 to 6 months, but everybody is different.
Yeah.
And to your point, not everything needs to be optimized. And in fact, not optimizing something sometimes allows you to do better with everything else. To your point,
yeah.
You keep a little bit more in cash because it lets you sleep at night. Sleeping at night, the return on that of having a good night's sleep and not worrying about your money is huge. But then it allows, if that's 10% of your net worth, and now it allows us to invest 90% better, even just from the math standpoint, that ends up working out for them.
Something that will be really useful, and I'm not the one to be promotional, but as we go through, you're using a lot of terms like risk and volatility and tolerance and capacity, and we're going to probably talk a little about stocks and bonds and all these. Your book, you have like specific chapters that dive into what are the differences. So if anyone wants to really nerd out, that's a good book.
Look at that. I mess up my computer and he gives a pitch for my book.
That's why I'm here.
We're a little bit burying the lead in this entire conversation of when we talk about risk and volatility, why risk questionnaires get it wrong. Here's the fundamental thing. Risk questionnaires are inherently saying is that stocks are risky and bonds are safe or conservative, right? That is their operating assumption. Everything follows from that, right? If you have a risk tolerance, that's what you're effectively answering. I think that is entirely flipped, all right? But let's just start with what is risk? Most people would answer just quickly, well, risk when it comes to investing is the chances that I could lose money, right? I don't think that's what we're talking about here when we're talking about long-term money. What I would define as risk is the possibility that you will not have enough money in your accounts when you actually need it, that it will not grow enough. You will not end up at a point where you have enough to support your living expenses, your life goals at the point that you need it. And I keep emphasizing that, not having a brain spasm. I am saying at the point you need it multiple times because that changes the entire conversation, right? If we look at stocks versus bonds over the long term, stocks have earned 10% annualized returns going back to 1928. So basically over the last 100 years. Bonds have earned more like 5 to 6%. It's actually gone down a little bit since like a lot of these studies, but further supports our point. But 10% versus, let's say, 6% for bonds or fixed income. If we subtract inflation, which has historically been about 3%, the difference is actually even greater, right? And that's why I like giving the nominal numbers first, because it actually becomes a bigger difference investing in stocks and bonds after inflation. 7% return versus 3%. So if we define risk as the chances that you will not have enough money 10, 20, 30 years from now, when you need to take the money out to support your living expenses, what's the riskier asset? The investment that's historically earned 7% or 3%? I would argue the riskier asset is the one that is barely outpacing inflation to the tune of 2 to 3% a year. Now, taking that one level further, the stock market over every 20-year period in history has had positive returns. Stocks are absolutely risky in the short term. And we'll touch on that in a minute. This is not stocks are always good. No, there's a real reason people think they're risky. It's because of how they operate in the short term, which we'll get to. But if you extend your time horizon long enough to 20 years, that's what it'll take. I think 15 years is 97%, 10 years is 83% of positive returns over these timeframes. And if you're curious, for one day, it's about 54%. So one day investing in the stock market is basically a coin flip of if you're going to make money or not. But I would say, who gives a shit? We would never be investing for 1 day, 1 month, 1 year, or 3 years. So if we're looking at 10, 15, 20 years, and we get to a point where every 20-year period is at positive returns, again, we come back to, in what sense are stocks a risky investment for the long-term investor? Now, all of this is with the massive disclaimer of these are historical returns. They are not guaranteed. Everybody knows that. I'm saying that for our back office compliance team, but history is the only thing we can go on. And in short of anything else, that is exactly what we want to operate on over a long enough time period. Yeah. The last year of market returns tells me absolutely nothing about how we want to invest for the next year. The last 100 years, the last 50 years, right? Multiple cycles over and over again does.
Yeah.
Volatility is a real thing. And when we say volatility, right, we mean what we're describing is the price fluctuations that you can expect investing over a short period of time, right? Literally like the gyrations of price that happen back and forth. So let's talk about that for a second, because I'm not trying to paint too rosy of a picture and have thousands of angry, you told me to invest in stocks and the market went down 20% because of XYZ. That is going to happen. Stock market goes down 1 out of every 4 years on average, right? There's a 20, 30% decline every 5 to 6 years or so. And even if we look back at recent history, 2022, the stock market lost 20% of its value, right? Last April, tariff day or whatever, freedom, whatever you want to call it, the stock market lost over 30% over 1 month period. 30% in a month. We're going to do another episode that gets a little bit more into the history, but 2007 and 2009, the market lost 57% of its value. Mm-hmm. You had $1 million at the start of that. Over 18 months, you're down to 430,000. So the markets can tank, and that is why, even as I'm saying that, our producer is like giving a, oh shit, that doesn't sound good. So there's a real reason why investing in stocks, you need to be able to emotionally handle it to bring us back. But again, if we are investing for the long term, and our job is to help clients maximize the return on their money 20 years out and 30 years out, we want to pick the asset that has historically done that, not the asset that maybe won't fluctuate as much in the short term, but is not going to outpace inflation over the long term.
My summary of this is risk is relative to when you need it, like when you need your money by.
Yeah, well said.
And I think the assumption
it just took me 17 minutes to get there, but
yeah, I'm the summary guy. One of the points I was going to make was I think a lot of these are for people who have a lot of wealth already, and they're now ready to live off of that wealth, and they feel like I need this all at once. And we're going to talk about that.
Yeah.
But the point I'm making here is, because risk is tied to when we need it, I think sometimes we just assume we need all the money right away, right now. When really, if we need this money in 20 years, right? And we look at history, stocks grow. And we want that to be there. So the real risk is not having what we need when we need it.
It's not being invested when all those, Gideon just said the market went down 20% here and 30% here. The market lost 37% of its value over 3 years. And we're going to talk about that in our next investing episode. But you can say, well, how are those things possible? And the market has had positive returns over every 20-year period in history. It's because those days when shit hits the fan, it goes up just as quickly after that. You don't know which is which. So you need to be invested the entire time in order to focus on the 20 years, not the 1 days.
Yeah.
You brought up sometimes people think they're investing for a point of life when they're going to need all their money at once. And now every study has shown the more you look at your investments, the worse you do. Right? Because look, think about it. If every day there's a coin flip of the market going up or down, and you look every day, half the time you're getting bad news. If you look once every 20 years, historically, you are literally only getting good news every 20 years or so. Even for retirees, right? Because there are definitely people listening to this, right? In the beginning, we said only our wives and our mothers are listening to this. And now I'm confident that we at least have like 5 or 7 other people that are listening, including all my dad's Brazilian Jiu-Jitsu buddies who bullied me into having LD on the last episode. But people are probably listening to this that are a little bit older. And they're saying, all right, well, Gideon, Jordan, everything you guys are saying, sure, if you're 30, if you're 40, all that's true. But what if I'm 50, I'm 55, I'm 60? And this is, I think, sometimes people that are closer to retirement actually even make bigger mistakes than people that are in their 40s, right? I think a lot of people have this idea that when they're 62 or 65 and they're retired, or 60 or 55, pick your number, that they're going to get to this point where, all right, they retire on Monday and on Tuesday, awesome. I need all of my money available now that I am retired to live on. That's not really how retirement works. If you're the average 62-year-old couple, healthy 62-year-old couple, somebody's going to be alive at 88. Statistically, somebody will be alive in their late 80s. So what we're saying is you have 25 plus years that you need your money to last, and not only last, but outpace inflation. Because the other key of this is inflation costs us 3% of our money every single year. Over a 30-year period, that means you are losing effectively 60% of your money to inflation, right? So if you start with $1 million, 30 years from now, you still have $1 million on paper. You can only buy 40% of the things that you could have bought 30 years ago. So if you are keeping your money in cash, if you're retired and saying, hey, well, now that I'm retired, I need this money in my pocket, metaphorically, you're actually losing that money. So we need 25 years of investing and outpacing inflation to handle the cost later in life. So again, how to invest for retirees is an entirely different conversation. The point here is, yes, if you're 65, you should be invested differently than if you're 55 or 45, but not that differently. I think people overrate, is kind of my point here, overrate how different their investment strategy should be if they're 65 instead of 45. And the other piece, and then I'll kind of end this part of it, is yes, should you be invested differently if you're 65 versus 45? Broadly speaking, yes. But if you've gotten to a point where you're financially independent, and you're no longer really investing for yourself, and I'll speak, my parents have done a great job, right? My dad talked about last time being financially independent. He's 63. If you're 63 and financially independent, and you're saying, hey, I'm never actually going to spend all of my money, and I'm investing for decades. It's literally how universities invest, right? Why universities have untold amount of money. And quite frankly, it's ridiculous. How much people have to take out debt to pay for college, that these colleges have billion-dollar endowments, is absolutely outrageous. But how are they able to support their endowments is because universities invest for hundreds of years. Wow, I'm really off the, right? Like we're way past the point I thought we were making a rib.
I was excited to see where it went.
Yeah, I could have ended up with like the Knicks championship again. We just like did a full circle and I didn't know where I was going. Point is, even in your 60s, you want to be intentional with how you're investing and not operate based on rules of thumb, of questionnaires. I think those are the crazy. It's based on where you're at, your risk capacity, right? What else do you have going on in your financial life that would allow you to support investing in a certain way?
It sounds like stocks are the best things to invest in. So why invest in bonds at all?
Good question. I think the best answer for somebody in their 40s is it is an emotional hedge more than anything else. I like describing investing in bonds or fixed income. Like imagine you're on a boat and you're 20 miles from shore and you put your anchor down to slow you down to make sure you don't capsize, that you're going at the appropriate speed. And then I would ask you, yeah, but we have 20 miles until we hit shore. Why would we put our anchor down now? We can do that. You have ways to go. I think most of the time investing in bonds or fixed income as a high income earning 45-year-old that has other assets, has money in the bank, other than letting you sleep at night, you invest a little bit in bonds to protect how much you can lose if that is going to materially freak you out. But yeah, I mean, the way we like to think about investing is I want my short-term money to be short-term and I want my long-term to be long-term, meaning we want money in cash if you are going to need it in the short term. Yeah. And when I say cash, I mean high yield savings, I mean money market, CD things. Yes, I don't mean literally checking account. We actually help clients maximize the cash they have on hand, right? Sometimes we have clients, something I'm thinking of last week, they exercise stock options and they have a $600,000 in the bank, and part of it we're going to have to pay taxes on over the next 6 months. So we don't want to invest it, but high yield savings, they can earn thousands of dollars. So we want it in cash, and then we want their long-term money, broadly speaking, in globally diversified equities, the stock market. So the answer is, should we own bonds? If it allows us to sleep at night, if it makes us feel better. But for the long-term young investor, I'll say it like this. I don't own bonds in any part of my individual portfolios, especially my retirement accounts.
My take on this is, if you have the emotional resilience to invest in stocks, it's a great investment, right? Because it's going to grow long-term. History is on our side. It shows that. To his point, when maybe we just need to feel a little bit better, feel a little less volatile, sometimes bonds make a lot of sense there. And so that's usually when we're putting in someone's account.
Yeah. When I say stocks or the stock market, let's define that for a second. We mean the entire stock market, right? Globally diversified portfolio where you own thousands of businesses, right? And I'll take it one step further, and we can end on this. What are we actually doing when we invest in the stock market? We are buying shares of the largest, most well-run, profit-seeking companies in the world. By being a stock market investor, you get to share in the profits of large, profit-seeking companies without having to do any of the work. So you're owning companies. You're not investing in stocks. You are shareholders in businesses, right? And the beauty of that is you don't have to pick the businesses. The businesses that do the best end up making their way into index funds like the S&P 500. What is that? The largest 500 companies in America. So you don't need to worry about, well, what are going to be the best stocks in 30 years? Say, well, if I own a broad, diversified bucket pool of index funds, of ETFs, you're going to own all of the stocks as they make their way in. So that is kind of a little bit too much in the weeds of stock investing. But I did want to level set that when we talk about stocks throughout this entire portfolio, that is what we're speaking about. With that, I think for anybody that is still with us after 30 minutes plus of stock market, risk questionnaires and thinking about your emotional makeup without at least side by side understanding your risk capacity, your financial standing, what your actual financial game plan looks like, and the most important investing question that exists, when will I need this money? Everything really follows that. With that, we wish you a great day. We're looking forward to speaking with you next week, and more to come. Thank you.